Hello everyone. Welcome to this special revision explainer from MAF201. Go ahead and grab your favorite pastel highlighters and open up GoodNotes because today we're taking a topic that usually causes, well, a whole lot of stress, and we're going to make it incredibly simple. And honestly, dare I say, fun? I know, process costing can look super intimidating on the syllabus, but just think of me as your friendly UITM lecturer, here to walk you through it step by step. By the end of this masterclass, you're going to be an absolute pro at joint and byproduct costing. So, let's jump right in.
Here's our lesson plan for today. We'll be covering foundational concepts, factory realities, the split-off point, step-by-step math, process accounts, and finally, some crucial exam tips.
All right, Section 1, Foundational Concepts. Let's meet the main characters.
First up, we've got the VIPs of the factory, the joint products. Basically, these are two or more products that are produced simultaneously from the exact same raw materials. They travel down the exact same manufacturing process together until they're eventually separated. Now, you really want to pay attention to that key phrase at the end of the definition, sufficiently high saleable value. Joint products have total main character energy. They are literally the primary reason the business is running the factory in the first place, because they're the ones bringing in the big bucks.
Now, let's contrast that with our byproducts. If joint products are the VIPs, byproducts are kind of like the accidental sidekicks. They emerge naturally during the course of production, but they weren't exactly the main goal. The absolute crucial difference here is their value. Byproducts have a relatively small sale value compared to those main joint products. They might be sold exactly as they are, or maybe they go through a tiny bit of further processing, but ultimately they're just bringing in a little extra pocket money for the factory.
Moving right along to Section 2, Factory Realities. Textbooks can make these concepts feel a bit abstract, right? So let's step inside some actual factories to see how this plays out in the real world. Take the sawmill industry, for example. The factory is cutting down trees to make wooden planks. Those planks, those are your high-value joint products. But as a totally unavoidable side effect of cutting wood, you get sawdust. The sawdust is the byproduct. I mean, it has some small value. Maybe you sell it for firewood or to prevent ice from melting on roads, but you absolutely wouldn't run a whole foresting business just to make sawdust. We see the exact same dynamic in the meat trade where dressed meat is the main product and hides for leather are the byproduct. Or think about the oil industry. We're drilling for petrol and lubricants, but we also happen to extract sulfur, which can be sold off for fertilizer.
Okay, Section 3, the split-off point. Now that we know who our products are, we need to talk about the exact moment everything changes for them, the split-off point. Imagine a literal fork in a factory's conveyor belt. Before the products hit this fork, they are all mixed together. Any costs we incur in this early stage, like raw materials or labor, are called joint costs. Because the products are physically mixed, these joint costs literally cannot be traced to one specific product. It's impossible. But once they hit that split-off point, they are separated. After this point, if we decide to spend more money on a specific product, that's called a further processing cost. And those are incredibly easy to trace directly to that specific item.
Section 4, Step-by-Step Math.
All right, team, take a deep breath. It's time for the numbers. But don't panic. We're going to break this math down piece by piece so it's super logical. Because we can't trace those joint costs directly to our joint products before the split-off point, accountants have to play fair and figure out a way to split the bill. We have two main methods to do this. First is the physical measures method, where we allocate the shared costs based on physical volume, like liters or kilograms. The second is the sales value method, where we split the bill based on how much money each product is actually going to make us, either right at the split-off point or after final processing.
But hold on, before we split that massive main bill between the VIP joint products, we have to deal with our sidekick byproduct. Let's say we have a byproduct named Lucky. Grab your calculators. Step 1 is to find Lucky's net revenue. We take the sales value, let's say it's RM200, and we subtract any additional processing costs specifically for Lucky, which is say RM40. That gives us a net revenue of RM160. Step 2 is where the magic happens. We take the huge total joint cost of the whole factory, let's call it RM15,000, and we subtract Lucky's net revenue right out of it.
Which leaves us with exactly RM14,840. I want you to draw a big, sparkly star next to this concept in your notes. This right here is your net joint cost. The byproduct was kind enough to use its small earnings to relieve some of the main cost burden for everyone else. So this RM14,840 is the final true amount that we are actually going to apportion to our main joint products using those physical or sales value methods we just talked about.
Next up, Section 5, Process Accounts.
All of these calculations have to live somewhere on your exam paper, right? And that place is your process account ledger. When you map this out on the credit side of a partial process account, you'll see our byproduct, Lucky. We just plug its net revenue of 160 straight in there. But when you look at our main joint products, let's call them Miracle and Wonderful, you'll notice we have question marks next to their RM values. Why? Well, because to fill in those blanks and actually balance this account, you must properly allocate that RM 14,840 net joint cost we just calculated between Miracle and Wonderful. If your net joint cost is wrong at the start, your whole account is going to be off.
And finally, Section 6, Exam Tips and Summary.
We are almost at the finish line. Let's review some crucial insider tips so you don't fall into the common traps that catch out so many students. Here are the red flags to watch for. First, never, ever mix up joint costs with further processing costs. Just remember the split-off point. It's the fork in the road. Second, if an exam question asks if you can trace a joint cost directly to a product, the answer is always 100% no. Third, always remember to deduct any extra processing costs from your byproduct sales before you use that number. Actually, scratch that. It's not just remember, it's an absolute must. And finally, don't forget that the net joint cost you calculate is the exact figure you must transfer and split in your process account to get those final beautiful balance marks.
If you remember literally nothing else from this entire explainer, make it this golden rule straight from your syllabus. The revenue from the byproduct sales is treated as additional income that will relieve some joint cost of the main product. That is the absolute heartbeat of this whole topic. The sidekick helps pay the bill so the VIPs don't have to carry the full weight.
And just like that, you've completely mastered joint and byproduct costing. You know your main characters from your sidekicks, you can spot the split-off point from a mile away, and you know exactly how to calculate and allocate that net joint cost. Keep reviewing those pastel notes, practice a few past year questions, and I promise you'll walk into that exam hall with total confidence. But before you go, think about the everyday things you buy, like a leather jacket, or maybe even wooden furniture. How many hidden byproducts do you think were created to meet them? And how did those little sidekicks impact the final price tag you paid? Thanks so much for joining me in this explainer, and happy studying.